Welcome to Chit Chat Money. My name is Ryan Henderson, and I am joined by my co-host, Brett Schafer, as always. Today, we've got our Thursday deep dive interview where we interview an analyst to discuss a single stock or industry. And today we have on the show, now recurring guest, Jim Gillies, and we're talking about a sort of an obscure or slightly kind of limited following financials company. And he wanted me to make sure it was clear that this is kind of high risk, high reward. So maybe not some of the typical investments that he's brought to the table before, a little more on the speculative side, but it is TFS Financial. And he talks through, he outlines basically everything that could go wrong and everything that could potentially go right. But yeah, Jim's an awesome investor. We have gotten a lot of ideas from him over the years, and he's really kind of helped us grow as investors in general. So really hope you enjoy this interview. I guess without further ado, here's our discussion with Jim Gillies.
Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schafer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are also general partners at Arch Capital, and Arch Capital may have positions in the securities discussed in this podcast. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guests is not formal advice or recommendation. Now please enjoy this episode.
Welcome in. Today we are joined by 5-time, 6-time, 7-time guest, somewhere in there, multi-recurring guest at this point, Jim Gillies. He is the lead advisor at Hidden Gems Canada for the Motley Fool. If you are interested after this episode in more of Jim's work, we've done a number of different episodes, including Winmark, Nelnet. Who else am I forgetting? International Petroleum.
RCI Hospitality, I think.
RCI. So we've done a number of episodes with Jim, and today we are talking about another potential hidden gem. And when I was messaging with Jim, he said, "I've got a fun one that's high risk, high reward potentially here." So it's called TFS Financial. Maybe. Can you start? I'm curious how you found this. So how did you even come across this to begin with?
I've owned it for a while personally. I think the former fool Jim Royal put me onto it years ago. And I do want to proviso this one. This could be a really, really bad idea. This could blow up spectacularly. Not because from the business, I don't want, and this, but because we are in the middle of what I've been calling a slow-moving banking crisis. Silicon Valley Bank says hi, right? And the problem with banking is it's a confidence game, not like in the sense that it's like a scam or something like that. But banks, if banks have the confidence of their depositors and the confidence of investors, they tend to be a pretty good business. But if y'all have heard of a bank run, if people decide that, the bank's going to close tomorrow and they all run to get their money out today and banks run levered, these things go boom. So TFS can be the most magically wonderful run bank in the universe. It isn't, but it's not badly run. But if the confidence were to evaporate, bye-bye. So
all right.
fair dues warning, right? But they can't all be fun things like Nelnet or RCI Hospitality.
Yeah, you're really trying to drive some virality here with this episode for us, right? Yeah.
I want people to understand. So, and I'll put it out here, and I'll flesh in the story a little bit. Somebody, and it might be me. Somebody has this one really wrong. Okay. So, where to begin about TFS? Okay, well, so TFS. Oh, go ahead.
I don't know. Maybe some history is important here. I know we're going to talk about that in a second.
You're going to get some history. You are going to get some history. Okay, so TFS is 85 years old. founded in 1938 at the tail end of the Great Depression by Mr. and Mrs. Ben and Jerome Stefanski. Okay. They are basically collecting deposits from their Eastern European immigrant neighbors in Cleveland, Ohio, kind of at, like I said, at the tail end of the Great Depression. The GI Bill post-World War II comes along. Like, I'm literally going to give you history. The GI Bill comes along, made, everyone wants the house. Everyone returning from war wants a house. Interest rates are kept super low to spur that. And it's a great time. It's a good time to buy a house. So, the 50s, 60s, 70s, here's TFS. They're expanding their savings and loan business. They're opening branches in and around the Cleveland suburbs. By the way, all my notes are on this screen, so that's why I'm always continuously looking off here, because I realize you're videoing this and I'm going to look like I'm staring in my corner most of the time. But, basically what they're trying to do is they're providing home mortgages for, Clevelandites, right? Cool. Great. 50 years go by, 50. And Ben Stefanski, a now highly advanced in age Ben Stefanski, is succeeded at the helm of the family business by his son Mark in 1987. But they keep on doing what they're doing. 20 years into Mark Stefanski's tenure, he decides to go public. Now, this company is not public in the sense that you guys think, or what we tend to think of as just a typical public company. IPO, take the capital, use it for growth purposes or to cash out insiders or whatever. No, TFS is what's called a mutual association. Have I lost you at this point?
Well, I think there's a quote, maybe just to spur some more discussion on this from there. I think it was they have it all throughout their investor relations page. It says, on September 30th, 2021, approximately 81% of the holding company's outstanding shares were owned by a federally chartered mutual holding company. Mm-hmm. And they talk about the difference between book value for minority shareholders and book value for mutual owners. So I haven't seen that before. I don't think a lot of listeners have seen that before. So what's the difference?
Well, and realize that is going to, if you were like, say, screening for financials, this one looks awful. Or not awful, but it doesn't look great. And I'll skip to a valuation portion here if I were to. A typical screener right now today would say that this bank is trading at 1.84 times book value and 43 times earnings. Who is excited about a bank at 43 times earnings and 1.84 times book value, right? Except that's not real, and I'm going to explain why. So, and it comes down to this is a mutual association. Okay. Mutual association it's a financial institution that takes in deposits and lends them out. So for a mutual association, deposits don't just represent the savings of its depositors. They also represent ownership stakes in the mutually owned institution. Okay. So, you guys are a lot younger than I am. You ever seen It's a Wonderful Life? Okay, so great movie. But the evil, villainous Mr. Potter during the bank run, where the long-suffering and self-sacrificing George Bailey and his wife give the $2,000 they've in 1946, by the way, the $2,000 they've saved for their honeymoon. They use it to backstop the bank. Right. And at the same time, some rando from the town runs in and says, Mr. Potter, the evil villainous Mr. Potter, of course, spoiler, but it isn't almost
it's just misunderstood. He's a misunderstood capitalist.
75-year, yeah, exactly. It's a 75-year-old movie. I don't think I need to give a spoiler warning for that. Or whatever it is, 75 years or something like that. But anyway, he comes and says, Mr. Potter's paying 50 cents on the dollar, for the townsfolk's deposits. And a bunch of people run and, but he's doing so, and it's better to get 50 cents than nothing if the bank runs out of money, because of course banks run leveraged. He's doing so to gain control because your deposits also represent an ownership stake in the business. So he's trying to get control of the bank to kill it. He's trying to get control of the Bailey building a loan to kill it. And so basically, key takeaway, depositors of a mutual thrift are also its owners. Okay. So if you want to grow, essentially a mutual thrift is basically limited. You have your deposits and you have any retained earnings you've built up over time. But if you want to go public, what the U.S. Federal Reserve will allow a thrift to what's called either partially or fully convert to a more traditional stock issuing, stock holding corporation. And it's what's called a partial conversion, or a second step conversion, or a two-step demutualization. If I haven't lost you yet, I'm about to. The thrift sells a minority stake in the bank, the shares of which become publicly traded and are what we all know and love of the shares. The rest of the shares are assigned to a new mutual holding company. Let's call that an MHC, which represents the interests of the depositors and the owners. So the MHC shares, they are effectively unissued. They count as shares outstanding, which is why those valuation ratios, the book value per share, trading at 1.8 times book value, trading at 43 times earnings, they count for accounting purposes, but they've not actually been issued yet. They're just held at the MHC. And in fact, if they were issued, you would sell them at the current stock price, which, in this case would have, in theory, and I'll explain why, you would have TFS here basically drowning in cash if they sold those things, because at this point, I'll get to in a minute. But basically, MHC shares effectively unissued. They count as shares outstanding, but they've not been issued. They haven't actually been sold. They don't actually have a claim on the earnings. If the thrift pays a dividend, which TFS does, the MHC traditionally waives the right to receive the dividend. If the thrift wants more capital later, it can sell some or all of the rest of the MHC shares to its members and become 100% shareholder owned. And in doing so, the capital raise would lead to an excessively well-capitalized company. Some companies, some banks, some thrifts basically take that first step and then do a second step later on, or required. In this case, what TFS did in 2007 was to sell that minority stake and then keep the remaining content in the mutual holding structure. And eventually, there's the hope it demutualizes the rest of the way down the road. The CEO, Mark Stefanski, here has said he's going to leave that decision for the next generation of Stefanskis running this business. He is 68 years old. His daughter is vice chairperson, so you can call her a nepo baby, I suppose, but maybe she makes the decision down the road. So basically, what you have here when they demutualized partway is they sold about a third of the shares, 32%. Okay. Which then meant inside the MHC, there was 69% of the shares outstanding were in that mutual structure that aren't really issued, but they're there. You're with me so far? Cool.
We follow.
Okay, Brett's nodding, but you look like you want to ask a question.
So, okay, here's the confusion. Is it how dilutive is it if they get become a normal bank or a normal publicly traded?
Right?
Okay, it's not.
Not at all. Well, because
it's not like a preferred. It's not like a preferred stock.
No.
Okay.
No,
okay.
If they were to issue the rest of the shares, and by the way, so yes, they did. I've just checked my notes here. They raised about $1 billion in capital in that first step of demutualization in 2007. Raised about $1 billion by selling a 32% stake. So 32% of the shares go out, 68% stay in the MHC. Today, 81% of the shares are in the MHC, and only 19% of the shares are outstanding. Okay.
So how did that work? Are they just buying back?
They bought back a ton of stock. Yeah. They bought back over 50% of the shares that were initially, or close to 50%. But they're, of course, they're equity cookies that people get, incentive stock and whatever all the way. But yeah, no, they bought back a ton of stock.
So those just end up being designated back to the mutual holding company.
Oh no, the ones they buy back get canceled.
Okay. All right. Yeah, that makes more sense.
They're gone. Okay. So here's TFS. They're newly public. Sorta, kinda. They're newly public in 2007. And they're a plain vanilla home lender, mainly in Cleveland and surrounding areas of Ohio. They're kind of now really spread across Ohio now. They also have operations, smaller operations. Their second largest operation in their state is Florida. They have some stuff in California, but basically the lion's share is Ohio and Florida. So everything's great, right? Okay. Something happened to the housing market in 08, 09. Something. And they didn't get in trouble the way some of their peers did, giving mortgages to anything with a pulse. But they did kind of loosen some of their underwriting. And, there was some programs, one of them was called Home Today, that applied, and this is a direct quote, less stringent underwriting and credit risk standards. Exactly what you want to hear from a lender, right? Oh, sure. Thank you. Yes, give easy credit to people who can't pay you back. Fantastic. Now, the total for the Home Today program was about 1.5% of the loan book at the time. Most were protected by mortgage insurance. Okay. That's great until the company who gives mortgage insurance, they go out of business because, home implosions, 08, 09. And as well, they did kind of try to alter their credit, the credit score requirements, but, they had some damage. And so, they'd also been a little too generous, providing second mortgages and HELOCs, during the housing market run up of the mid 2000s. And so these things all together basically caught the attention of the regulator. And the regulator, in response, issued several what are called memoranda of understanding, MOUs, basically demanding things like a review of the potential overexposure to home equity loans, risk management procedures for managing interest rate risk, management compensation. But importantly, under the MOUs, TFS is barred for 4 years, mid-2010 through mid-2014. They are barred from paying dividends or buying back its own stock. Okay, so you're done until you can demonstrate that your house, no pun intended, your house is in order. Again, they weren't, frankly, they weren't anywhere near as bad as a lot of the other companies out there. But the other companies that were worse, a lot of them are no longer with us. And because it's a regulator, when the regulator is telling you thou shalt do this or that, regulators don't tend to move terribly quickly. They have no incentive to move terribly quickly, right? So this was, even though they cleaned up everything, what they needed to do, and like for example, that Home Today program in fiscal. They have a September fiscal year. So fiscal 2007 is the year. The 12 months ended in September of 2007. At the end of fiscal 2007, so kind of right at the peak of, before the mortgage market rolls over, the Home Today program made up 3.7% of the $8.2 billion loan portfolio. 3.7%. For comparison purposes, and there has not been there's not been a Home Today loan written under that program, written by this company since 2009. And today it is 0.35%. It's about $50 million. So it's 1/6 of what was around in fiscal 07. It's about 0.35% of, I think it's about a 14.5, $14.6 billion, looking it up now, $14.56 billion loan portfolio. So this is a rounding error, basically, at this point. Even if they're all zeros, who cares? And they're not even remotely zeros. So, but anyway, they have this 4-year period. They are not allowed to pay, they're not allowed to pay dividends. They're not allowed to buy back their own stock. But, they clean up what they have on the books. They shore up the portfolio against interest rate risk. They diversify geographically. That they really in again, in fiscal '08, I think Ohio was close to 3/4 of their lending. Today it's about 53%. Florida was about 20%. Florida is actually today about 18%. So it's actually lower because they've expanded in other areas. So just, get a little geographic diversification going on. And they made sure that they kind of tried to address some of the interest rate risk in case interest rates went up. I mean, I know it's a quaint notion, but sometimes they do go up. And so basically they I think I'm trying to look here at my numbers here. About a third of their loans in '07, or like right before the things go boom, about a third of their loans were in variable rates or adjustable rate mortgages, or just like a HELOC, which just floats with rate changes in real time. Today, I think it's about 52 or 53% is in these adjustable rate products. So, and TFS throughout this period. So now we're kind of getting into the mid-teens, 20 teens, and TFS is really, we're like, going to lift the MOUs, like, let's be nice, and they're really signaling we are going to, we are going to return capital. We've been barred from returning capital to shareholders for 4 years. We're going to party when these MOUs come off, right? We're going to go. And so it was, and that happens in mid 2014. And they immediately come out with a 28-cent per share annual dividend and an aggressive buyback. So 28 cents in 2014. By the way, today the dividend is $1.13. Okay. The yield on this thing is about 9.4%.
And that's today on that.
That's today. Oh. Today the yield is 9.4%. Which do you remember that part at the very start where I said someone has this really wrong and it might be me? 9.4% is the market screaming at you this dividend is going to get cut, right? Let's not.
An earnings yield at 10% is considered, like, people look at that and say this is dirt cheap. So when it's a dividend yield,
yeah, especially in earnings at 10 times, people are saying they think that the earnings are going to go down.
Yeah, there is no good story tied here. People don't think and they haven't for a while with this bank, that CEO Stefanski, I'm going to paraphrase, what did he say? Every press release, or maybe he doesn't do it anymore, but he used to. Every press release, he would it's sunshine and blue skies for TFS Financial. I don't know if he still does that, but he used to a lot. And I'm just here to say the world does not look at TFS Financial and see sunshine and blue skies right now. But I'm not sure the market's right either, to be honest with you. Anyway, so 2014 happens, dividend comes back, and it's been aggressively raised. Buyback comes back, it's been aggressively raised. Ryan, to your earlier question, that's how you get from 32% of the shares start out as being publicly traded then after the demutualization to just shy of 19 or around 19 today. They have, they've really kind of stuck to their knitting. The delinquency on the portfolio, I mean, they've stuck to plain vanilla mortgage lending and house lending primarily. I had really quick numbers here. Like 80% of their loans are their core residential mortgage offerings. About 18.5% are HELOCs or lines of credit. Again, I mentioned that one product, the Home Today stuff that got them in trouble circa 2010. That's a rounding error. They have some small construction loan exposure, less than 1%. I mean, they have really stuck to their knitting. And they have a delinquency rate super low. Like, they look like 85 years. They look like what a bank with 85 years of experience of just doing very plain vanilla lending. This is what this looks like. Okay. So now when we've covered the demutualization, we've covered the history here. We get to today, and Silicon Valley Bank did no one any favors. Like, this was a $14, $15 stock earlier in Q1. They just reported, we're recording this on Friday the 28th. they reported earnings last night, and the market didn't particularly enjoy them, but whatever. They were cheap before; they're cheap now, so whatever. But the fear when Silicon Valley Bank goes down is that deposit flight from all but the so-called too big to fail institutions will kill every bank eventually, and then eventually you get the Canadian banking sector where you have 6 big banks and really nobody else.
The contagion concerns.
Exactly. It's like, backstop all depositors and I can see the argument. I understand that. I don't happen to think that that's likely. But Silicon Valley Bank kind of spooked people, and Signature and, First Republic looks like it's circling the bowl as we speak. So, what are you going to do?
34% dividend yield I saw today on First Republic. So
yeah,
that's a great example of that.
When they cut all of their preferred dividend yields to zero and said, and by the way, these aren't cumulative, so you guys are out of luck. That would be First Republic fools or folks. Sorry, force of habit. That was probably. I know there were people who were excited to get back into First Republic for Bargain Hunter at $16, but I was like, with all due respect, you should stay on the sidelines. As I like to say, you should teach yourself to run towards fires, because as a value investor, that's interesting to me. But don't run towards all fires. Some fires will kill you, and First Republic was very much. And also, I had the same question: Bed Bath and Beyond. Oh, is this a fire worth running to? No, it isn't. Anyway,
and fires in the financial sector, especially when a fire can spread.
Well, exactly. And look, there's a really good history, just to kind of maybe take it back for a bit. I alluded to the Canadian banking sector. For those who don't know, I am a Canadian, which I suppose you should probably have figured that out since I run Hidden Gems Canada. Proud Canadian, stressed out Maple Leafs fan. Our banking sector, the whole thing is too big to fail, right? It just, it's highly, highly regulated. They're incredibly diverse. Their mortgages, their personal loans, their lines of credit, their investment banking, they are insurance products, they are wealth management, they are investing, crap mutual funds. They're incredibly broad businesses. A bunch of them have been around since before Canada was literally a country. They predate Canada's Confederation, 1867. So a couple of them, I think, have paid dividends longer than Canada's been a country. But during the 2008-2009 crisis, they got just pummeled, just like everything else financial did, right? And I was on record at the time as saying Canadian banks do not cut their dividends. Canadian banks do not. The government will backstop them. They're better off than a lot of the other banks which didn't have their exposure. They're certainly better off than Lehman or Bear Stearns or whomever, who focused, of course, on investment banking and had worse leverage. But I said Canadian banks don't cut their dividends. They will raise capital before they will cut their dividends, and they will survive and they will grow. And at the time, but that didn't, you still had you had Bank of Montreal trading at an 11 or 12% dividend yield. You had a couple, I think you had most of the rest of them over 8 or 9% dividend yield. If you just bought a basket of the Canadian banks when it looked the worst, I think your annualized return, including dividend reinvestments, well north of 15%, probably beating the total return index over that same period of time by a good 5 or 6 percentage points a year. So running towards fires is a good thing. And so the question I've been asking myself, I'm saying, okay, TFS is a fire. Okay. I said, I've owned it for a while myself personally, but they are on fire today, but I don't think it's warranted, or I'm not sure it's warranted. And again, with my fair dues warning at the start, I might be wrong, but and so let me see if I can justify that perhaps stupid commentary. So first I'll go back to the valuation argument. So once you realize that the MHC unissued shares, which are counted in the PE ratio and the book value ratio. Those aren't real. You get to what you were asking about earlier, guys, the minority shares, minority value per share, that's what matters. And what matters is, so there's 280, just over 280 million shares outstanding for this, but 227 plus million of them are held by the MHC. So we ignore those. So the actual share count outstanding is about 53.2 million. And when you divide the earnings and the book value by that and apply it to the current stock price, you get a stock that's trading at about just over 8.3, 8.4 times earnings, and a price to book for the minority shares, price to book of 0.35 times. Okay. And I've got myself a nice little price chart of what the valuation has been. And if I tell you that 0.35 times, that is the lowest valuation on record. The average valuation is about 0.6 times book value. But this 0.35 is lower than the 4 years when they were under MOU restriction, no dividends, no buyback. It is lower than the pandemic drawdown in the first quarter of 2020 when the world was ending. You know, you guys might remember the world actually did not, in fact, end. It is the lowest in history. So that's an interesting signal, I think. And again, things are signals to me. And okay, well, the fear associated with Silicon Valley Bank, of course, was deposit flight, and all the big tech guys, you know, had many multiples of their deposits north of the $250,000 FDIC guarantee deposited there, and like, oh crap, and you know, pull it out. I don't know if I can curse on this show, so I'll keep it clean. And so, well, again, remember here, there is a little bit of a different beast here, and the depositors are also the owners of those MHC shares, right? So there's a little bit, maybe I should pull up the actual spreadsheet because I'm looking at from last quarter's notes. They did report last night. So this is a company this is a bank that has about 16.3 billion in total assets. Of those assets, 14.6-ish, just shy of 14.6 are loans or mortgage. The vast majority of which, like almost all of them, are mortgage loans. The plain vanilla stuff that they do. So what is financing the loans? And what is financing the loans? So about, again, 14.5, 14.6 in loans. That's really the key meat here. Backstopping that is just a hair over 9 billion in deposits. So checking accounts, savings accounts, certificates of deposit, brokered or otherwise.
I'll hold it there. I guess, what do you think of these depositors? I mean, is it just mostly just people in Cleveland and all over, and
Florida? I'm going to guess that you're not shopping from, say, Austin, Texas, or Milwaukee, Wisconsin, or Portland, Oregon, looking for an extra few basis points on a CD. And I found one in TFS. Like, I'm going to guess it's mainly local or relatively local. And they kind of talk a little bit about that, but they are very much about, we've raised deposits from our local neighborhoods to then go out into the world and provide these same people mortgages and what have you. So 9 billion deposits, and about as of last night, 5.2 with the just released earnings report, 5.2 billion in borrowings, mainly from the FHLB, right? So the FHLB, the Federal Home Loan Bank, if you will. So that is a system chartered during the Great Depression with a mission to basically provide financial institutions with products and services to assist in the financing of homes. So banks like TFS buy equity in the FHLB system and then get access to liquidity through loans and advances. They're secured by TFSS's investment in FHLB's equity, as well as a blanket pledge of its mortgage portfolio. Okay, so I was a little concerned. I think if you are looking at bank stocks during this time, given what's happened with Silicon Valley Bank and given what's happened with with First Republic, I think you have to. The first question I think has to be, are these deposits safe? Like I think you have to be asking that question. And so I asked that question. Well, actually I took some comfort from last night's earnings report when I saw that the deposit base at the end of December, so the end of 2022, was 9.014 billion. Okay, so 9 billion and 14 million. And then just reported last night for the quarter ended March, so March 2023. So now we are Silicon Valley Bank, for those who don't remember, it went boom on March 10th. So this is right in the teeth of it. A lot of the banks that I follow and look at, they bottomed out on March 24th. So this is as of March 31st. Deposits shrank from 9.014 billion to 9.003 billion, $11 million.
And it's at a time when people can earn more on the cash. I mean, there's withdrawals coming out of all sorts of banks. It doesn't necessarily mean people are flooding out.
Let me lead into that next question we have then and I think a lot of people have this on their minds. Even anyone that's not an expert in financials knows that interest rates affect banks. How has the trend in interest rates impacted them over the last year? And what do you think that sets them up? Are they under earning right now, or are they over earning? I'm glad they don't have exposure to commercial real estate. And if they do, maybe let us know. But interest rates, how is that affecting them, and what could it mean for the next few years?
Yeah, I'm looking for my thing. So this the most recent. I thought I had that. There we go. So this recent most recent earnings report. So because of the speed of interest rate hikes, right, the fastest ever, that is hurting a lot of banks. I think it's hurting all banks. It was most pronounced at Silicon Valley Bank because they had themselves billions of dollars, I think 90 odd billion in face value or purported value, 90 odd billion and I promise I'm going to get TFS, but they had 90 odd billion of held to maturity, long dated, low interest paying mortgage securities, essentially, that they couldn't sell, which had a value. I think it had something like a $16 billion, mark to market loss. But because they weren't selling it, because they called it held to maturity, they didn't have to take that loss. But the $16 billion quotational loss is interesting because that's basically also equal to what their equity was. So if they sold one of them, they have to remark the book, and then we call that, the word we use is insolvent, which is not a good word for banks. So with TFS here, they are not unaware of interest rate risk, and the risk there is they've got a bunch of mortgages issued previously during the time of zero interest rates. But to keep competitive, they now have to pay a higher rate, an ever higher rate on what they're taking in from depositors. And look, again, they're getting of their 14 plus billion in funding, 9 billion of its depositors, 5.3 is from the FHLB. That is they've got that swapped out with an interest rate swap, so that's largely fixed. So they should be good there.
FHLB.
Yeah.
So
FHLB.
Okay.
Did I transpose some of those?
No. I was just making sure that
they swap out their interest rate risk where they can. You can't really do it when you're borrowing from or I've got $10,000 in a checking account and whatever. I'm not gonna. They're not gonna swap out on individual accounts, but they do make some use of swaps for interest rate management purposes. But Brett, to your point, it is getting a little crimped here. So the most recent quarter, or for the first quarter of this fiscal year, fiscal 23, Interest on earning assets was 3.6%. Interest on liabilities was 1.85%. So the interest rate spread was 1.75. The net interest margin was about 1.95%. This latest quarter, they've just brought out interest on earning assets 3.79. So it's up about almost 20 basis points. But on the interest earning liabilities at 2.23, it's up over 40 or almost 40. 38 basis points. So the interest rate spread has fallen from 1.75 to 1.56. The net interest margin has fallen from 1.95 to 1.78. So there has been an impact from the rapid interest rate hikes. This may in fact get worse in the next few quarters. It may not, but what they have again is to combat that. So first off, any new lending they're doing, especially the fixed rate mortgage, obviously any new lending is now at higher rates. We understand that rates have gone up. So, the days of the 2.5% mortgage are probably done for a while. The other thing is of their loan book, as mentioned, about 52%, I think it's just slightly over 48% is in fixed rate loans. So if we loaned out super low, well, also there's 15 and 20 year loans on the books here, right? From previously issued. So those are much higher, but the stuff that they lent out at super low rates, that's just got to work its way through, and those are paying what they're paying. Probably not a lot of people refinancing their mortgages right now, but yet the depositors and the borrowings, those rates are going up. So that's going to pinch a little bit, and it has been pinching a little bit. I think an all-time low valuation in the history of the company as public, I think that's probably factored in a little bit, but whatever. And so the other thing though is 52% of their loan book is variable or adjustable rate mortgages. So the variable stuff is just floating so rates have been going up now, those have been going up now, period, full stop. Adjustable rate mortgages, there's a certain amount. I think they pretty much all adjust over the next 5 years. I don't have that open really quickly, I don't think. Yeah, I'd probably just be guessing, but here I'll do a search for ARMS just for fun. Yeah, okay. So there we go. As of the end of fiscal 2022, so the year ended September 30th, 2022. The adjustable rate mortgages. So again, not the variable stuff. Just the adjustable rate mortgages made up a total of 4.7 billion of the loan book, which is I think ballpark just over a third. Most of that resets in 2025 through 2027. So you're going to have to live with some of that. But when they reset, they might be significantly higher if interest rates keep going higher, or if you believe some pundits who say, it's going to flatline. Canada has already flatlined their interest. We've plateaued our earnings rate or interest rate hikes. I know you guys are still going, but I suspect you might follow our lead at some point. So that's gonna eventually tamp down. Of course, the pace of increases is greatly slowed, and that's all we really kind of ask. It's hard to work your way through. I think I'm roughly right, but precisely wrong. I think the Fed funds rate went from 25 basis points to 4.5% in the span of a year.
Yeah.
I think I'm pretty close, right? That is going to throw some. That is going to hurt.
Yeah, and I was listening to an interview the other day where it's who knows if it's going to just stay flat, but I think because of the banking collapses as of late, it may have forced the Fed's hand to have to keep it and not keep raising it.
Yeah.
I guess I guess for context for listeners, 9% of home loans in the US are adjustable rate mortgages. So it's surprising, I guess, to me that FSL has 50% in either basically variable or adjustable. Is that, am I wrong here? Or is that common?
Well, it's funny you put it that way, because as a Canadian with a radically different mortgage system where all of our mortgages are adjustable, We like a standard mortgage. It's just a standard. You go out and buy your first house. You take a 25-year amortization, okay, and what's called and then you have a term. So you'll generally the most common is a 5-year term. So you know what you're going to pay for 5 years. But at the end of those 5 years, you have to go and reshop your mortgage. And if interest rates have gone up, you're going to be paying more. And if interest rates have gone down, you're going to be paying less, right? But for us, like, you're saying there, oh, this is kind of strange. I would humbly submit to my American friends that you guys don't know how good you got it. The rest of the world deals with this all the time. No,
Yeah.
I'll let it. But no, this doesn't. That's not what bothers me. There are some things that bother me. No, but I actually think it's prudent that they have about 40% in ARMs and then another chunk in, because the variable stuff is HELOCs, right? Like, I mean, like I've got on my house here, I have a HELOC against my house. So if I needed to buy a car, I could just, strike a check from the HELOC and there's my car. But like the HELOC is tied to prime plus a slight premium, which I don't remember because it's been so long since we've used it. But let's say it's prime plus 1%. Well, when the prime rate was flirting with zero, we might have been paying 2.5% for the HELOC. But today, if we borrowed against it, we might be paying 8% on it, right? And that. And there are people who live on their HELOCs who will live for years. And also, too, I don't know if this is the case in the US. I can tell you it's the case in Canada. A lot of HELOCs are they're interest only. So you can borrow against your HELOC and then never pay it back. You can just as long as you're making the interest payment. But if you borrowed at 2.5 and now the interest rate's gone to 8.5, you've probably cut down on your fine dining experience outside because you're paying that much more for your housing costs. And there's a whole other subset argument we could talk about financial planning prudence. But no, I that doesn't bother me at all. In fact, I actually think it's prudent to have that type of exposure so you can not get hurt by a bunch of people took out 30-year mortgages at 2.5%, and now a comparable mortgage might be, say, 6.5%. And a deposit might be demanding 4%. Like, there's not a bank in the world that can make lending at 2.5 and paying at 4.5. There's not a bank in the world will make that math work. So,
yeah, and I guess because maybe it's sometimes hard to follow the interest rate talk as a listener, but it's because they have so much of their loan book that's variable or adjustable. They're able to raise what they earn much quicker than someone who has a bunch of fixed rate debt that doesn't necessarily have to be mortgages. I mean, in Silicon Valley Bank's case, I think it was mostly like longer term treasuries or something like that they kind of sell. So,
they were I think they were Fannie and Freddie mortgage-backed securities.
Oh, they were MBS. Okay.
Yeah, they were. I mean, and they were like 1.5% in a world where your deposits were demanding 3%. Like that's
right.
That ain't gonna work, guys.
So I guess ultimately, this is a bank that could see some interest margin compression.
Already
potentially
is.
In the short term.
Is, I would say already is. Yeah.
Do you think there's any chance that they end up cutting this dividend or shrinking it?
There is. I think you have to always accept that that's a possibility. And I think that the way the stock price has been acting the last year or so, I think the market suspect it's going to go away. The funny thing is they're like remember, they don't pay the dividend to the mutual association, the MHC shares. They only pay it on the publicly issued shares. Their payout ratio is still less than 1, like still less than 100%. So that's interesting. And again, as I've tried to go through, we haven't even talked about how well capitalized this bank is, right? But I've tried to go through, and at the Fool, the analysts at the Fool, we're generalists, so we don't have a dedicated specific tech analyst or banking analyst or retail analyst. So I would welcome input from banking analysts to educate me on what I don't know. But I look here and I say, okay, I'm reasonably comfortable with the deposit base. I'm reasonably comfortable with the loan book, with the split between the adjustable and the fixed, and the variable and the fixed. Capitalization wise here, like they've got their tier one capital, tier one leverage ratio, capital and net average assets is 11.27%. The rules are you need to be 5%. They're more than double what they need to be. Their total capital to risk weighted assets, they're at 20.64%. The rules require to be at 10%. I mean, they're really well capitalized. And that's why I say if they sold the rest of those MHC shares, even at the low price today at 0.35 times book value, they just decided to, the heck with it, just flood the balance sheet with money. Because that we'll survive then. I'm not sure what it'd do for you because, so capitalization, I'm not worried about. Credit quality looks good. Interest rate, there is, as you said, and we've talked about, there's some compression there, but I don't see how there wouldn't be in the world that we've just kind of lived through, and I don't want to drive with my eyes on the rearview mirror. I want to believe that my personal belief is that going forward, interest rate hikes, if they happen, will be fairly muted and slow from here, because I do think the Fed is scared. I can tell you the Canadian central bank was clearly scared, and they stopped a lot earlier. And it looks like they're being rewarded for it. Inflation in Canada, I think we fell to about 3% or just over 3% in the last report. So, it's working. I've also kind of been on record in various places saying, all the talk about a recession and what that's going to, I'm not really buying the recession, or at least the severity of a recession coming. So I'm not too worried there. So I'm trying to go through here and go, okay, so what my takeaway from this bank is that everything it's a nice little boring savings and loan, plain vanilla mortgage lender focused in Ohio and Florida. Good credit quality, great capitalization ratios. The interest rate issues, probably I think I get it, but I think it's handleable. I'm comfortable with the balance sheet. All-time low valuation, approaching 10% dividend yield. One of us is wrong. And as I said, it might be me, but these are the things that I tick down and go, what am I missing?
It sounds like if rates stay flat and the multiple doesn't change, investors are getting a 9% return, 9.5%, whatever the dividend is. And at least there's some comfort in knowing you don't need a multiple re-rating to do well here. You'll literally get the cash at 9, on an annual basis or quarterly basis. I guess my question would be kind of upside wise, have deposits been growing? Is there the chance that this dividend grows over time?
Well, I think they've raised the dividend since they brought it back at 28 cents in 2014. I think they've raised it every year. Now, not all raises are equal, of course. I think they raised this year to $1.13 from $1.12. They may have paused the raises during pandemic. I don't have that sheet up in front of me, and I'm not going to bother looking for it. You guys can look it up. Going from $1.12 to $1.13 just to say you raise the dividend, that doesn't impress me too much. But the fact is, the dividend is, as you say, still being paid. I would probably, and I would probably want them in this present in market. The one thing as well, just to stood out in Q2, and I'll kind of tie it into this here if I can, is they have really pulled back on their lending. Now, their first mortgage, which is the first mortgage loan portfolio, which is, of course, as I said, the lion's share of their loan book. Average credit score 761 seems pretty good. Average loan to value of 66%. So, I mean, houses could literally fall by a third, and the collateral, if you have to seize it, probably covers the loan. But what was interesting in the report from last night, new loan growth in new mortgage loan growth was 87 million for the quarter and 306 million year to date. That compares to 453 million in the quarter a year ago and 618 million year to date in the period a year ago. So they've cut year to date numbers by about half, and they've cut in the most recent quarter, they've cut lending by about, 4/5, 80% or so, as I just ballparked it. They're clearly seeing something and being really stringent on credit. Like that's the only takeaway I can have there.
Do you think it's the affordability? I don't want to call it a crisis, potential crisis.
Less mortgage demand.
Yeah. And maybe there's no mortgage demand out there. I think in the US it's just dried up.
I think it's probably a complex and nuanced answer. I can tell you what's going on here. So I live in southwestern Ontario. Just think the greater sprawl that is Toronto. House prices here went stupid during the pandemic, and people clearly willing to blow their brains out, taking ever greater mortgages and just stuff that make me and my significant other, who is a chartered accountant, so we're great fun at parties. Just make us just, we have hives when we hear some of these stories and see what's going on, but people are making it work. During the 2022, things came down. House prices in Ontario, even across Canada, even where we live, I think house prices were down 20 to 25%, but volume has just gone away because it's too expensive. So, people don't want to, if I've got a mortgage locked in sub 2% and I have to get a new mortgage when I sell, and a new mortgage be at 6% or 6.5%, why on earth am I going to sell, right? I'm not going to give up my 2% mortgage. Even in Canada, I'm not that dumb. So it might be an affordability thing, but now you're seeing in Canada, where I am, it's ramping back up again. We're back, baby. And again, I don't think that's a great idea, but it's not my money, so it's fine. So I think it's probably pretty nuanced, Ryan. I can see it being an affordability issue, but I can also point you in that. Well, you guys know John Rotanti is a good friend of mine, so Rotanti's been banging the drum on home builders and on the fact that the U.S. has been underbuilding for the better part of a decade and a half, and yet you've got household formation. People are getting married, they want to buy a house, they're moving to places where they can buy a house. There's not enough houses in your country or mine. And so you'd think there should be more demand. So I think it's a pretty nuanced, probably a pretty nuanced calculation, which is a fun way to say I really don't know. But I do, what I can say is, just by looking at the numbers, they pulled in hard in this quarter. Maybe there's not the demand there. I don't know, but they still insisting on. Let me see if I got the right screen up here. Let's see. Yeah, like they're the new loans they just did in this most recent quarter. So again, the portfolio had an average credit score of 761, average loan to value of 66%. What little loans they did this quarter, average FICO score 774, average loan to value 71%. They are not hosing out high risk loans to high risk people here, or high ratio loans to high risk people here, which again makes me say, okay, are they dialing it back for a few quarters, perhaps? Let some of the older stuff roll off the books, which is good, and just trying to let the banking market kind of calm down. Because as someone who was doing this professionally during the credit crisis, I tell you, boy, that was a scary ass time. But it fades. It fades. People forget, and then of course they go commit the same problems that they had the last time. So I am watching that. I am not thinking you're going to get a great capital return from here anytime soon. So yeah, the dividend is probably all you're going to get for a while, folks. But I also, if all of the positive and the conservative things that I think I see here, I don't know why this thing couldn't get back to a historical average level, say 0.55, 0.6 times the book value, the publicly traded book value, and just for a comparison of that, as I flip sheets yet again, 0.55 times book value, would would give you a $19 stock price. Stock price is 12 today. So, and then what if you got more? Like, what if it actually went higher than just the long run average?
Yeah, any multiple expansion would be kind of cherries on top of already a pretty strong dividend. I think that
there's also the upside that maybe eventually they do go through with the second stage and go right to you wouldn't want to do it at this low price if you didn't have to, or the U.S. banking sector. What was there, like 25 or 30,000 banks a century ago, and now there's 4,000. Like that number, the ones that are gone from that number went somewhere. A lot of them were acquired, and a lot of these small thrifts and whatever, they do ultimately get acquired. I can't see Stefanski selling at this low valuation, but it wouldn't shock me to see this one eventually gobbled up by a larger entity.
All right, I think that's all the questions we have. Unless, do you think there's anything else to add, or do you think we covered it well, Jim?
I hope I've covered it reasonably well. Again, I welcome the banking analysts out there to come tell me what I'm missing. I hope this continues my streak of at least bringing interesting names.
They've all been winners. So
well, I'm gonna try to go against you. I'm gonna try to take myself down, I guess. We'll see.
All right. Well, that is going to do it then. We want to remind listeners that Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Money is not formal advice or recommendation. We are, however, general partners at Arch Capital, so clients may have positions in the securities discussed in this podcast. Thank you all for listening. Thank you, Jim, for coming on again, and we'll see you all next time.